What's up everyone, it's Kadi with MoneyVest. So in this video, we are going to be talking a little bit about Vertex Pharmaceuticals. So this is a company that, in my opinion, is one of the best biotech companies in the world when it comes to cystic fibrosis. So that's exactly what we're going to be talking about. This is a company that I invested in back in 2021. This was a stock that obviously was selling off back in the day. It pretty much traded down to, I believe, in the low 200s. And of course, now it's trading back up to all-time highs of well over $460 a share. And believe it or not, this was actually one of the stocks that saved my entire portfolio. And a lot of members, of course, ended up investing in this company back in 2021 when there was an entire bear market happening, or excuse me, back in 2022, because an entire bear market was happening. And this stock ended up, of course, outperforming a lot of stocks during that time. So this right here was the entire, rebound for Vertex Pharmaceutical, trading back up to $468, up 168%. So this right here was a low under $200 a share in the 170s, and I specifically did videos on this stock talking about how this was a no-brainer buying opportunity because it was trading at very, very inexpensive multiples and valuations. And of course, since it has rallied over 170%. So I'm going to break down everything about this company because it's still, from a long-term perspective, if you got a 5-10 year time horizon, Vertex Pharmaceutical is still one of the best companies, like I said earlier, in the world when it comes to biotech. So we're going to break all that down. As always, make sure that you drop a like and subscribe to the channel if you're just joining us for the first time. And again, links to our Discord and Patreon is going to be down below. We've got a 51% discount right now for the entire MoneyVest.com platform, and you can get early access for the beta launch. And right now, this is going to be a special pricing that you can lock forever, and that's at $29 a month, and you'll have access to the entire platform, and all the additional features and tools and functionality is going to be available to you at no additional cost. So we're going to be working really hard over the next 6, 12, 18 months, adding more features, more functionality, more data for all of you. And you can pretty much access it, and you can lock this pricing in for a huge discount because eventually the price obviously is going to go up. So links are going to be down below. We'd love to have you on board. So let's start with the company itself. So they are the pioneers in CF treatment. So they basically focus on cystic fibrosis treatment. They're a leader in the research, and one of their biggest and most popular drugs is Trikafta. And that has, of course, done really well for the company. I'll go over some of the specifics for this company in terms of numbers in just a minute. And if you take a look at some of the other projects that they have in the pipeline, sickle cell disease and beta thalassemia. Then we got Duchenne muscular dystrophy. Again, I do apologize for the pronunciations here. There are some pretty difficult words. We got pain management. We got alpha-1 antitrypsin deficiency. It's quite a mouthful here. This is a lung disease, and Vertex has a potential treatment in development. This is a red blood cell disorder. Vertex is developing potential treatments to improve the lives of patients, and this is a genetic muscle disease, and Vertex is researching therapies to slow and prevent muscle weakness. And they've also introduced, I believe, CF for a certain age group as well, which has opened their market up to more and more patients that they can actually cure with their pharmaceuticals, of course, with their with their medication that they provide. Now, overall mission is to discover, develop, and commercialize innovative medicines for people with serious diseases, and they are heavily investing in science and collaboration, and by focusing on these areas, Vertex aims to make a significant impact on the lives of patients battling serious illness as well. And this right here is the breakdown between Trikafta and their other CF products, which is by far one of the most popular products here in the market, so generating almost $9 billion in 2023, and total CF product revenue was 9.87. So of course, majority of that revenue coming in from Trikafta of just under $9 billion, and first quarter 2024, a little bit over $2.6 billion in overall revenue, of which $2.5 billion coming from Trikafta, $207 million coming from other products. Non-GAAP operating income, $1.35 billion here, 50% margin. And we're looking at non-GAAP net income of $1.24 billion. Last year, we're just shy of $4 billion and about $15 in earnings per share. We can also confirm this from our own platform. So if you come over to the annual numbers, let's just go back to the last 5 years. For 2023, for net income, we're looking at $3.6 billion, and right now they've got 3.97. So this might be on a GAAP and a non-GAAP basis, and we're looking at shares outstanding of $15.23. We've got earnings per share diluted $13.89. Again, that might be a GAAP and non-GAAP basis discrepancy there. between our platform and of course the reported numbers, because these are non-GAAP numbers for the company. So looking at the some of the guidance from the company here. So when it comes to reiterating the product revenue, $10.5 to $10.75 billion in total product revenue for the business. And if you do a full blown analysis on the company here, so coming over to the company's overview page, you'll notice that they are with an M score of 3.27. So it's a little bit lower than what it used to be. It's closer to 4 in the past. It's now, of course, come down because of the fact that the valuation has, of course, increased. And let's just take a look at what are they scoring low on. So if you do a 5-year analysis on this company, you'll notice that we've got revenue, very nice consistent growth, going from 4.1 billion to well over 9.8 billion. That's a 26% compounded annual growth rate. So that's a very nice consistent growth, as you can see on the chart here. If you plot for gross profit, operating income, then we've got net income, and then let's plot free cash flow as well. You'll notice, again, very consistent growth across the board. Gross profit has grown at 26%, operating income at 42% on a compounded basis. Net income is up about 11.5% here, because I'm sure they've got a pretty big expense in the middle, which we'll take a look at. And free cash flow is up over 22% growth over that same time period. So everything is very well in terms of growth to high growth here. And on a 5-year basis, they actually score a 3.7 out of 5 in terms of that M score. Now, if you come over to the shares outstanding, let's just plot for shares outstanding here. You'll notice that it's been more or less reasonable. There hasn't been any share dilution. It's been pretty flat, so they haven't really diluted shares all that much. If you come over to 7-year analysis, it's been more or less the same. So you can see it's been very, very flat in terms of the shares outstanding. So let's just come down. Let's look at some of the margins. Gross margins have been coming down slightly. They've gone from 89% down to 87%. Operating margins have expanded from 15 to more than 38%. Net margins have also expanded from 10.5 to well over 36% here for the company, and EBITDA margins also gone from 18.25 to well over 40%, and free cash flow margins from 23% to 33% for the company as well. So every single margin here has increased. Gross margins have been more or less very stable at well over 87% for this business. So very, very strong. One more thing that I want to show you is if you come over to the financial table and just plot cash, debt, and net debt, what you'll notice is that that is also excellent. Cash has been increasing, which is the green, at almost 14 billion. Debt's been relatively small at under $500 million, and net debt has been increasing, which is a good thing because you want to have the company more cash than debt on the balance sheet. So if I remove for cash and debt, you can see that it's been only increasing to the downside. That's exactly what we want to see from the business. And then also, if you take a look at some of the efficiency metrics, so return on assets for the company in 2023 at almost 16%, a little bit lower than the average of 18.5 on a 7-year basis. Return on equity, we're looking at 20%, again, slightly lower than the average. And then stock-based compensation as a percentage of total revenue, operating cash flow, and free cash flow, it's reasonable on a revenue basis at 7.89%, but as a percentage of operating cash flow and free cash flow, it is most certainly high. Because if you come back here, it has been coming down, so that's good. It was at over 50% at one point back in 2017 and 34% back in 2017 for operating cash flows, and it's been coming down, but it is still, I would say, a little bit over 16 to 17% respectively. As a percentage of revenue, it is low at 5.89%, so that is good for the company. So it's been coming down, but on average, it's been a little bit over 20% for the company. So something to keep in mind for efficiency-wise. Now, if you come over to the valuation, you'll notice that, Vertex Pharmaceutical back in 2017, very, very high multiple, but it's more or less traded in and around the 20 level. Average has been around 18.3 on a 7-year basis, and right now, as of 2023, trading at 29. So yes, it's a little bit more on the expensive side because it's trading well above its 7-year average P multiple. Price to sales trading at over 10.6 compared to an average of about 11.2. Surprisingly, biotech company trading at pretty expensive price to sales multiple, so that would be considered as somewhat reasonable and on par with its average, and price to free cash flow at almost 32 versus an average of about 41. But in the past, a lot of these numbers are kind of, getting somewhat, what's that word here? They're getting influenced by the 2017 number because they was really, really high. So that's why the average is getting pulled higher. But if you come over to, let's say, a 5-year analysis, and if you come down to the valuation, and now you'll notice that it's more or less reasonable because the average for price earnings 27, 10.6 price to sales, a 28 times price to free cash flow. So now it's a little bit more of a premium in terms of price to free cash flow. So if you come back over to the chart, you'll notice 2023, of course, pushed higher a little bit compared to the last 3 years, which has been closer to 2018 to 20. And the reason being, of course, because it's trading at a new all-time high and it's pushed higher. If you take a look at price to operating cash flow, same story at over 29, almost 30, and price to earnings at over 29 as well. So valuation-wise, it has most certainly been trading at a little bit slightly higher than compared to its last 3 years because, as I said, it has moved higher quite a bit and it's trading at pretty much all-time highs at the moment. Now, if you come over to the analyst estimates, right now we've got a buy rating on Wall Street with a high price target of about $605, a low price target of $320, and an average price target of $477, which is somewhat on par with where the price is trading at the moment. And if you take a look at the analyst expectations for earnings per share, the average is $13.89, expected to grow to $35.26. And that's going to be about a 12.25 to 12.35%, give or take 12% expected compounded annual growth rate for Vertex Pharmaceutical, and revenue is expected to go from 9.8 to well over $20 billion. And that's going to be a CAGR of just under 10%. So we've got over a 12.5% CAGR for EPS and just over 9.5% CAGR for revenue. And price to earnings multiple on a forward basis, of course, is going to come down from 26 down to 13, considering that the compounded annual growth rate and earnings are going to grow for the business. So if we apply a 12.5% growth rate for discounted earnings multiple model, and let's just plan for the next 7 years. We'll do a 7-year analysis, $3.6 billion worth of net income as of last year. We apply a compounded annual growth rate of 12. Let's just do 12.5%. Expected P multiple of, I believe, 18 is fine. So that's a 7-year average of about 18. I think that's okay. 12% discount rate, 10% margin of safety. And the company really hasn't bought back any shares. It's been more or less stable, as I showed you earlier. So if we hit calculate to figure out what is Vertex Pharmaceuticals' present value in terms of the fair value based on forecasted earnings growth of 12.5% and an 18 times P multiple, applying a 10% margin of safety and a 12% discount rate, we get an intrinsic value which is significantly lower of $224 per share. Now look what happens if I increase the PE multiple, which if you come take a look on a right now on a ratio basis, if you come down, right now the price to earnings multiple is over 30 on a trailing 12-month basis. So this is exactly what I'm talking about, right? So it's all a game of numbers. It is quite literally a game of numbers. And, a lot of people, tell me that, based on this analysis, there's no stock out there that's worth the Bible. And that's true. I did a video earlier talking about how it's becoming harder and harder to find opportunities. And why is that? Because prices are at an all-time high. Everything has pushed up 100, 200, 300%. And that's exactly why it is more and more difficult to find good quality stocks trading at a cheap discounted valuation. That's how it is. Look at the real estate market right now. It's becoming harder and harder to find good deals that you can actually buy because of a couple of reasons. Number one, interest rates are high, so cost of money is high, and also prices are high. So if interest rates were high and you were able to buy homes really cheap, still you'd make the deal work, right? Even if the cost of money was high, but you're getting a huge discount on the price, you'd still be able to make the deal work. But right now, the cost of money is high and prices are high for homes. And as a result, you're not able to get any good deals. And that's why it's harder and harder to find deals. And that's why, this is all a numbers game. So look what happens if you run the same analysis, right? So if you do like a 7-year forecast, we do a 12.5, keep everything else the same, and just increase the P multiple to 25, right? Not even 30, but from 18 to 25. And now if you hit calculate, we're getting a fair value, which is only 34% lower than where it's trading at the moment, and $305 is going to be that number. Now look what happens if I do 30. So if I hit calculate now, and now we're only 20% away from the actual price, which is 367, 366 as the intrinsic value for Vertex Pharmaceutical. And this is going to be that sensitivity grid. If you believe that it should be trading at 32, 34, 36 times earnings, then of course your fair value is going to be higher. And based on your growth rates, again, it's going to fluctuate. But if you believe that, okay, it deserves 12.5%, but a significantly lower P multiple, then of course you're going to be sitting somewhere in the low 200s to mid 200s for Vertex Pharmaceuticals. So it's all a numbers game. You can make the stock whatever you want it to be. If you want, I can make this undervalued for you. If you come over here, let's just do 18% growth rate and a little bit of a share buyback of -2%. And now if you hit calculate, boom, 34% undervalued, fair value at $628 for Vertex Pharmaceuticals. So you can analyze. That's the beauty of this tool, is that you plug in the numbers and you figure out, okay, what is the intrinsic value for this stock, for this company. And if you go over to a 5-year analysis, let's just do a 14%, 25 times P multiple, everything else the same. Hit calculate, and now we're looking at a 26% pullback needed, which I think is quite reasonable. If you go with, let's say, a 12% growth rate, let's see what that looks like. We're looking at 33%. I think 5-year analysis at close to 314, 315 would be quite fair for Vertex Pharmaceutical. That's about a 25 times P multiple, slightly higher than its average of 7 years, which is 18. But it's a premium stock, very high margins. It's one of the leaders in the biotech sector. So of course, I don't mind paying a little bit higher for this company. So 315, low 300s would ideally be a very good support and intrinsic value for this business. And right now we've got a support sitting roughly at 362. So that's going to be the first level, all the way down to $338 for Vertex Pharmaceutical, all the way down to as low as $280 per share for Vertex as well. And then of course another support level sitting right over here from back in May 22 at $240. But the first support level is going to be down at 381. So hope you all enjoyed this video and a complete update on the markets, on the Vertex Pharmaceutical stock here, not the markets. As always, make sure that you drop a like, subscribe to the channel. Again, if you want to get access to this entire platform, we've got a 51% discount right now. You can access this special price for a very limited time. You can lock this price in for the MoneyVest beta launch. We're going to give access to everybody this entire platform on July 8th. So link's going to be down below. We'd love to have you on board. And as always, happy investing, and I'll see you all in the next video.